Now, would you like to know the secret to getting rich?
Of course.
Of course! Okay, so here it is. Are you ready? You might want to write this down. Okay, so it's earn more than you spend, or let's put that a different way. Spend less than you earn. Does that make sense? Spend less than you earn and invest the difference. Now, let's talk about how we can increase wealth. Where is our wealth coming from? Our wealth, oh, that's a piss poor marker. Okay, our wealth comes from our investments. So we want our investments to go up. Now, there are two ways we can increase the amount that we have to invest. First of all, we could earn more. Anybody here work an hourly job? How can you earn more? Work more hours, right? And this is what my dad would always do down at the dynamite plant. Anytime there was overtime, man, he was there, right? But you're limited by two things: your hourly rate and your physical exhaustion, right? I've worked 72-hour weeks before and was making money like crazy. But I was worn smooth out. I had no time to spend that money. Okay. On the other hand, we can talk about spending. What can we do with our spending?
Spend less.
Yeah, we can spend less. Oh, by the way, let's talk a little bit more about earning here. So if I am limited by my hours, there are a couple of things I can do. Number one, you can, oh, for shame, she's late. Okay, you can get additional education, right? I was making $3.65 as a grocery sacker when I graduated high school. I went for more education and got my first job as an engineer in 1994, and I was now making, let's put it in hourly terms, so I was making around $19 an hour, so that's like a big improvement. And then I got my MBA, and you basically double that, right? So I invested in education, and that was how I increased my earnings. The other way is that you have to be willing to move. My dad was a sharp guy, but he wanted to be in that town, right? And so he wasn't willing to get extra education because there weren't jobs for that there, or he wasn't willing to move away, right? And so I looked at all this and I said, you know, I really enjoy air conditioning, which would be under spending. By the way, I grew up without air conditioning or remote control on the freaking TV. I'm like, yeah, I want that, right? And so I decided I've got to go away for education so I can earn more. Now let's talk about spending less. Look at what you're spending on. Remember we talked about non-value add things that people spend money on? What do you think, like Doge? What are they looking at? They're looking at those non-value add costs, right? So go through your life and look for those. So that's how you can get rich. Is it going to happen overnight? No, this has to be a consistent thing. And when should you start?
As soon as possible.
Yeah, as soon as possible. And here's the trick. You guys right now are probably making somewhere between jack and squat, right? You're used to being poor. And so when you get that first job, you're gonna have way more money than you even can contemplate what to do with. Here's the trick. As soon as you can, max out your 401k, max out your investments, because you will never miss that money, right? Because you're poor. Now, trade off that crappy car, do something for yourself, right? But still, get started on that when you won't miss the money. Do you think it's good to like wait 5 years and get used to living a really great lifestyle and then start investing and saving? No, because you're gonna, yeah, it's a bad deal. Okay, questions? I need to plug a microphone in here. Hopefully. Okay, now last time that we were here, we were talking about bond vocabulary, and I said there were two things up here that shift with the market on a daily basis. What were those two things? Price and yield and maturity. And what was the relationship between them? When price goes, yeah, they are inversely related. So if prices are up, yield and maturities are down. If yield and maturities are up, prices are down, and all that. Okay, now we've got the coupons are typically fixed, though we will discuss some cases when they're not. The face or par value is typically fixed, so of course we'll talk about an exception to that. The coupon rate, of course, it goes along with coupons. Maturity does change over time. How does the maturity change? Every time another year passes, we have one less year to maturity. However, the maturity date stays the same. Does that make sense? Okay. Now, let's talk about the value of a bond. If you bothered to watch my lectures on Chapter 4, at the very end, I said the value or price or value of anything is the present value of the expected future cash flows discounted at a rate appropriate to the risk of those cash flows. And that's exactly how we're going to value bonds, how we're going to value stock. Everything is valued that way. By the way, that's how you value real estate too. Okay, so what do we have the cash flows with bonds? Well, we have these coupons that are being paid out every 6 months or every year. Those are your interest payments. And then we have that big old chunk of money at the end. We already know how to calculate present values for annuities. What's an annuity? It's a set of identical cash flows happening over the same frequency over a set period of time. And so those coupons are actually an annuity. And that future value, the face value, sitting out there at the end is just a big old lump future value. And it turns out that our calculators, we know already, can give us the present value of both of those things. And the cool thing is it can do both of those things at the same time. So it's not like we have to find the present value of the coupons and then add the present value of the face value. We can do it all at one time. Now, what is the discount rate? Well, it's that yield to maturity. But remember, yield to maturity is an APR. And so we're going to have to divide that yield to maturity by the number of coupons per year to come up with the appropriate rate for that period between the coupons. Are there any questions so far? What's the default face value or par value? $1,000 I may ask you that like 5 more times and we'll see. So who was it that said 1,000? Would you pass this all the way up to the back, please? All the way up to the back. Thank you. No pocketing. I saw that. I hope you actually passed that other one along.
I did. She's super excited to get it over spring break.
Cool. Okay. So here we go. We've got a bond with a face value of 1,000, but I didn't really even need to tell you that, right? It's got a coupon rate of 6% and 10 years to maturity. Interest is paid annually. What does that mean? How many coupons per year? One. The market requires a 6% return on this bond. What is that 6%? The second 6%? It's the yield of maturity. Anytime you see a market required rate for bonds, that's the yield of maturity. And we already know that the coupon rate is 6%. What is the market price of this bond? If you don't already have your calculator out, I want you to get it out now. And we're going to use these time value of money keys right here. What's the first thing we should always do when using these keys? Yeah, second clear, TBM. Okay, now on bonds, the first thing I like to do is just go ahead and put in the 1,000 for the future value. Because no matter what else you know or don't know, typically that's done, right? Okay, now the next question is, what are we going to put in for our amount of each coupon? Any ideas? 60. How did you get that?
6% multiplied by 1,000.
Yeah, 6% of 1,000. Now, here's the fun thing. 6%, by the way, dividing by 100% is perfectly okay, right? It's just like dividing by 1. And I'm going to multiply that by the face value of 1,000. So as long as I always have a face value of 1,000, all I really have to do is multiply that coupon rate by 10, and it gives me the annual coupon rate. So if I've got an annual coupon rate of 7%, what would my annual coupon be? 70. And if I've got an annual coupon rate of 120, what would my, 12%, it would be 120, right? Okay, so let's go ahead and put that in. By the way, where do you think we're going to enter that 60? PMT, because remember, it's like car payments, right? It's an annuity. Okay, now, let's see, what else have we got here? It tells us the market requires a 6% return on this bond. That's the yield to maturity. Where should I put that? I over Y. And then how many years to maturity? 10. And what did we say is the price or value of anything? It's the sum of the present values, right? So what we're going to do here is compute present value. Now, I want you to notice a couple of things. Number one, the price of the bond is exactly the same as the face value. You will hardly ever see that. You will hardly ever see that. And the reason that you see that is because this bond, the coupon rate is identical to the yield to maturity. Only when the coupon rate is equal to the yield to maturity do we see bonds selling at face or par value. And in fact, we have a special name for a bond like this. We call it a par bond. Now, I told you the other day that usually face and par are interchangeable terms, but you will never hear anybody refer to this as a face bond. We always call it a par bond. Now, the second thing that I want to point out is that present value is negative. Mr. Ellis, why is the present value negative?
Because you have the future value set as positive.
Okay, I had a future value set as positive, but what else did I have set as positive? The payment too, right? The coupons. Now, here's the way to think about that. I'm going to buy the bond with the present value. That's a cash outflow. That's negative. Then when the coupon comes, is that money that I'm receiving or paying? Receiving, that's a plus. When I get the future value, is that money I'm paying or receiving?
Receiving.
It's receiving, so it's a plus, right? And so it's the sign convention of the TIBA to plus, and cash flows in different signs have different directions, have different signs. Now, could I have made present value positive and the payments and the future value negative? Absolutely. As long as payment and future value signs match and the present value is the opposite, it's all good. But in your mind, I would think it's easier just to make the present value negative. Now, it really doesn't matter when we're doing stuff like this, but it's going to before the day is over. Any questions so far? By the way, on the exam, would the answer be minus 1,000 or 1,000? Yeah, it's going to be 1,000. Now, here we have basically the same bond, but interest rates have gone up by 1%. And if interest rates in the overall economy go up by 1%, likely the yield to maturity of this bond is going up by 1%, and that's exactly what we see. Now, keep in mind, I already have all this stuff in my calculator. What is the only thing that I need to change?
7 I
Yeah, I'm going to do 7 I over Y. And then what am I going to compute? Yeah, compute the present value to find the price of the bond. Now, this bond is selling for $929.76. This bond, any bond that sells for less than its face value is called a discount bond. Any bond that sells for less than its face value is called a discount bond. And why does this thing sell at a discount? It's because the coupons are not enough to satisfy the investor's required return. The coupons are not enough to satisfy the investor's required return. And so as a result, not only do they require the coupons from us, but they are only willing to buy the bond at a discount because they're going to use that capital gain from $929 up to 1,000 to make their total return on this bond equal to 7%. So, on a discount bond, the coupon rate will always be less than the yield to maturity. On a discount bond, the coupon rate will always be less than the yield to maturity. Now, you may, by the way, how many of you like a sale? Don't we all love discounts? And you're like, woohoo! It's like the bond's on sale. Is it? No, the bond is correctly priced for the required return of the investors. And so this bond is not on sale. You shouldn't say, wow, I'm going to go out there and buy that bond because it's on sale. In fact, I can only think of one reason to prefer a discount bond to a par bond. And that is, I don't have $1,000. Maybe I only have $950. I could afford this bond. Could I afford the first bond? No. Questions? Okay, now let's move on to the next one. Now we see that the overall market interest rates have dropped 2%. So the yield to maturity on this bond is down to 5%. And so we are just going to say 5, I per Y, compute present value. Now this bond is selling for $1,077.21. Is that more or less than face value? More. This is called a premium bond. Anytime a bond is selling for more than face value, we say it is selling at a premium over face value, and we call it a premium bond. Now, undoubtedly, you guys are familiar with premium brands. I see a Mercedes hat in the back row. Yes, he knows it's a premium brand. Did you pay more for that hat than you would have paid for a Volkswagen hat? Yes, absolutely. Now, we think of premium brands as being better, and they are. However, a premium bond is not better than a par bond or a discount bond. You're not going to take this bond downtown and say, ooh, check out my premium bond. It's nothing special. It just is selling at a premium because the coupons are more than enough to satisfy investors' required returns. The coupons are more than enough to satisfy investors' required returns. And as a result, investors are willing to actually suffer a capital loss on the bond. And so the coupon rate is greater than the yield to maturity. When I combine it with that capital loss, now the actual return on the bond overall is the same as the yield to maturity. Okay, any questions so far? Man, this stuff seems easy, doesn't it? It is, but we're going to start throwing in some complications here. Yes?
So you said the only reason you would buy a discount bond is if you didn't have $1,000. If you had $2,000, would you always buy a premium bond?
No. If I had $2,000, what would I buy?
Just
Two par bonds. Very good. Thank you. You've already got your coin for today. Okay, so here we have a bond with a face value of $1,000, coupon rate of 6%, 10 years to maturity. The interest is paid semi-annually. What does semi-annually mean? Twice a year. How come ladies know this and men do not?
Sales.
Sales, right? Semi-annual sale. Why do I know this? Because I have a wife. Okay, semi-annual sale. Okay, so it's happening twice per year. But remember, when we do the coupon rate times the face value, it gives us the annual amount of coupon paid. So to find out the actual amount of each coupon, what are we going to have to do? Yeah, you got to divide by 2. The other thing that's going on here is that the periods are half as long. So we've got twice as many. And so we're going to have to multiply the number of years by 2. Okay. So let's go ahead and we'll clear out our calculator so we can get some practice entering stuff in. Second, clear TVM. What's the first thing I always put in?
$1,000.
Yeah, 1,000. And I hit what button next? Future value. What should I put in for PMT here? 30, because it's a 60 annual coupon divided by 2. What should I put in for N? 20. Oh, and something I didn't mention earlier. What do I need to do with the yield to maturity? I got to divide it by 2. Remember, the yield to maturity is an APR, which means that's a semi-annual rate times 2. So I've got to divide that by 2 before I put it in here. And hopefully you guys can do that in your head. It's 2.5%. Okay, what do I do now to find the price of the bond? Compute present value. And I come up with $1,077.95. Is that more or less than the last bond that we did?
It's slightly more,
It's slightly more. Does anyone know why?
because you're getting paid more often.
Yeah, it's compounding, right? Because you're getting your first interest at 6 months instead of 1 year. What can you do with that money? Invest it, right? And so that's why this bond is slightly more valuable, because of the power of compounding. By the way, do you think you should put on your note sheet, for semi-annual bonds, double N and cut I per Y and PMT in half? Might be a good idea. Might be a good idea. I mean, you guys probably remember it right now, but when you get into the heat of battle, you may forget. Okay, moving on. Now we're going to start seeing where the negatives and the positives start to matter. A bond with a face value of 1,000. By the way, did I even have to tell you that? No. Has a coupon rate of 6% and 10 years of maturity. Interest is being paid semi-annually. The bond is selling for $864.10. What is the yield and maturity for this bond? What's the first thing I do with my calculator? Second, clear TVM. What do I put in first? 1,000 future value. What do I put in for PMT? 30, right? Because it's semi-annual. Now, what should I do with this $864.10?
Negative.
Yeah, I should do 864.1 negative, and then what? Present value, very good. And what do I put in for N? 20. I think I've got everything in there. What do I compute now? Compute I over Y. Now, I over Y basically is 4%. Is that your yield to maturity? Miss Seiko says no. What is it?
That's the semi-annual rate.
That's the semi-annual rate. So what do we have to do with it? Yeah, we got to multiply it by 2. And so the yield to maturity for this bond is actually 8%, not 4%. Questions? Now, what if we had screwed up the signs? What if I had had 864.1 and, and then tried to compute I per Y? Error S or error 5. It's actually error 5, but if you think error S, that's the sign. It means you got your sign screwed up. But I've got some bad news for you. Let's put, come on. Let's see, recall PV, negative PV, there we go. What if I just get, what if I just put the wrong sign on PMT?
It'll also throw an error.
It's not going to throw an error.
It's gonna be just wrong.
It's just going to be wrong. So do you have to actually have your crap together? Yeah, you probably do. Actually, that's a rule in life. Have your crap together. A bond has a coupon rate of 6%. Interest is paid semi-annually. The bond yields 7% and is selling for $973.36. How many years until this bond matures? Oh my goodness! I didn't give you the face value. What do you do? Yeah, it's 1,000. It always is unless I tell you otherwise. So let's get our calculator up here. What's the first thing we always do to our calculator? Second, clear TVM. And then what do I do?
1,000.
Yeah, 1,000 future value. Let's see, interest is paid semi-annually. It's a coupon rate of 6%. What do I put in for PMT? 30. What do I put in for yield, for I per Y?
3.5.
3.5. I got to divide that yield to maturity by 2. Now, let's see. There's one more thing I need to put in. 973.36. What do I do with that? Got to be negative, and then what button? Present value. Now, what do I compute? Compute N. Is that 6 years? No, it's 6 semi-annual periods. How many years is 6 semi-annual periods? Divide by 2, right? So it's 3. It's 3. A bond is selling for $1,071.70 and has 4 years left to maturity. Interest rate is, the interest is paid semi-annually. The bond yields 5%. What's the bond's coupon rate? I want you to mark this slide because this is the most complex bond calculation I will ask you to do. It's got at least 1 or 2 more steps and then the other ones. Okay, so here we go. Get our calculators up. What's the first thing we do with our calculator? Second, clear TVMs. What do I put in for N? 8. What do I put in for I per Y? 2.5. I got to divide that 5 by 2. And then let's see what else we've got. Oh, by the way, we know 1,000 future value. Do we know the payment? No. And so I think that's what we need to calculate. But what do we need to put in first? Yeah, 1071.7. Mr. Ellis, what do I need to do to that? Negative. By the way, if you wonder why I'm picking on Mr. Ellis on this stuff, it's because he had the error on exam 1, and we talked about it, but I want him to remember it for a freaking error. And the rest of you too. Okay, so I think, are we ready to calculate something? Yeah, what's the only thing left we have that we can calculate? Payment. Compute. Payment. And so we see the payment here is 35. How are we going to use the information that the semi-annual coupon is 35 to get to the coupon rate? Yeah, first thing we have to do is multiply it by 2 to get to the annual amount of coupon paid. And so that means our annual amount of coupon paid is 70. How can I convert that 70 into the coupon rate?
Divide it by 1,000.
Yeah, divide by 1,000 gives us 0.07 or 7%. Or you could just remember this whole you could divide by 10 and do the same thing. Do you see that had some extra steps to it? Okay. Now let's talk about pricing zero coupon bonds. If you had to guess, what is the coupon rate on a zero coupon bond? 0. It's a big fat goose egg. These are called pure discount bonds because every bit of the return is that capital gain from the discounted price up to the face value because there are no coupons. Now, if you are a rational thinker, you would say, okay, we'll just price this as we've got 0% getting paid annually, or zero coupon getting paid annually, and then I can price it that way. Wrong. Zero coupon bonds are priced as if they are semi-annual. Let me say that again. Zero coupon bonds are priced as if they are semi-annual. Now, you're probably saying to yourself, why the hell would we do that? And the answer has to do with history. Historically, bond traders, do you think bond traders have a PhD in finance? No. Do you think they even have an MBA? No. In fact, many of them don't even have college degrees. You say, how in the world does this happen? And the answer is how things used to work at the brokerage houses. You would start out with someone working in the mail room. Do you guys know what the mail room is? That's where people are trying to get inter-office mail and stuff to the correct people. Now, if you're an idiot, can you do that job correctly? No. No. So this is our first test, right? We're going to see if you're an idiot. If you can't deliver the mail correctly, then you're out of here. But assume that you do a good job in the mailroom. Now I'm going to offer you a position as a runner. This is where the people are taking orders and they hand this paperwork, because it used to be paper, right? They hand the paper off to the runner, and the runner takes it to the trader, and the trader places the trade. Now, if you do a good job as a runner, eventually the traders say, hey, you want to give this a shot? Actually, they'll start by asking questions like, what do you think is going to happen next? Do you think when you are hanging out with other people trading bonds that you can get a feel for what's going on in the market? Yeah, you know there's fear and greed, right? And you can smell them both. Okay, now, if I ask you, what do you think is going to happen next? And you're right, like 9 out of 10 times, what do you think I'm going to offer next? Hey, would you like to try your hand at this, right? And if you're good, then you become a bond trader. Where in that did this person ever get any education? Nothing, right? And so why do we treat these as semi-annual bonds? Because every other bond these people are coming across is semi-annual, for the most part. Overwhelmingly, semi-annual is the thing. And if I want these people to be able to price things correctly, then I just price the zero coupons in the same way. Questions? By the way, do you think being a bond trader is a good long-term strategy for your life? No, they tend to be obese, alcoholics, smokers, and die in their 50s. So, you know, if you want to sign on for that sort of stuff, feel free. Otherwise, I would recommend finding a more pleasant life like I've got. Okay, questions? Now, why does it matter? Because the effective annual rate of that semi-annual pattern is higher due to compounding. Remember, we saw that one bond was a little more value because of the semi-annual versus the annual. It's the same thing with the zero coupon bonds. Now, let's talk about what happens to a bond as it ages. And this is going to get pretty dark here, so prepare yourselves. When I hold a brand new baby, by the way, I hate holding babies, but when I hold a brand new baby, babies are people. They're tiny people, right? And people are scumbags. What does that make babies? Tiny scumbags. Okay. So when I hold a baby, I look at this baby and I say, you know, this baby could be the president. This baby could be an astronaut. This baby might even become a finance professor. Dream big, right? Now, do we know what we actually only know one thing about this baby? What is the one thing we know for certain about this baby, barring a supernatural event? They're gonna die. I told you it was gonna get dark in here. Okay, now, no matter what fabulous life this baby goes on to lead, folks, we all end up food for worms. We all end up in the same spot. By the way, that's why I'm getting cremated, because I don't want to get eaten by the worms. Plus, it'll be easier for my wife to haul me around. Okay, on with the story. It's a dark, dark day. On with the story. Bonds are the same way. I don't know if this bond is going to go up in value or going to go down in value, but I can tell you this. With 1 second left in that bond's life, after that last coupon is paid, I can tell you exactly what that bond's going to be worth. How much? The face value, right? It's going to be worth $1,000. Because what's the present value of $1,000 1 second from now? That's $1,000. Like the rounding error is less than a penny, right? So I know it's going to end its life at $1,000. In the meantime, though, if it started life as a premium bond, what's going to happen is that bond price is going to drift down toward $1,000 over its life. And if it's a discount bond, that bond, its value is going to creep up toward $1,000 over its life. So that means that we can expect a capital loss on these premium bonds, and we can expect a capital gain on these discount bonds. Now, this picture that I've drawn here is very pretty. And the reason it's very pretty is because I assumed a constant yield to maturity. What did we say changes every single day based on the activity of the market? Mr. Tibbs, what changes every day? Yeah, the yield to maturity, right? It changes every day. So this picture isn't accurate. But here's what it would look like with real yield to maturities. This line would jump up and down, but it's still going to wind up in the exact same place. This line is going to jump up and down, but it's still going to end up in the exact same place. So, once again, I'm going to say it one more time. A premium bond, you can expect a capital loss over the life of the bond. And for a discount bond, you can expect a capital gain. By the way, that is a great test question. That is a great test question. Questions? Okay. Now let's talk about current yield. If I say the term current yield, you're like, oh yeah, that's a yield to maturity today. Wrong. Current yield is its own thing. Current yield is its own thing. Write this formula on your note sheet. Write this formula on your note sheet. So current yield just takes the amount of the annual coupon and divides it by the bond price. It's not the same as yield to maturity except for in one very specific instance. When would current yield be equal to yield to maturity?
When the.
Yeah. Did you say par bond?
Yep.
Yep, par bond, exactly. I would give you a challenge coin, but you're like, he's, oh no, I gotta go. Okay, here we go. I could tell he was going to be sorely disappointed if I didn't. Okay, now let's talk about what happens here. For discount bonds, the current yield is lower than the yield to maturity. Remember, yield to maturity for a discount bond includes both the coupons and the capital gain. So that current yield isn't capturing that capital gain. However, for premium bonds, the current yield is higher than the yield to maturity because it's not taking into account the capital loss. It's going to be higher because it's not taking into account that capital loss. Now, if you're lucky on an exam, I will not give you enough stuff to figure yield to maturity. And then you'll be forced to remember, aha, he's actually asking for current yield. If you are unfortunate, I will give you enough information to calculate both. Do you think you're going to be fortunate? No. No. This is how we separate the A's from the B's, the sheeps from the goats. Questions? Now let's talk about interest rate risk. We talked about this a little bit in chapter 10. The longer the time to maturity, the greater the interest rate risk. And it all boils down to how we value bonds. We said that the bond value is just the sum of the present values of the future cash flows discounted at a rate appropriate to the risk. So here's our basic present value formula. Even if the future value stays the same, each one of those coupons and the face value stay the same. If R goes up, TV goes down. And if R goes down, TV goes up. Now, here's the funky thing. We've got this T here. What do you think T stands for? Time. If let's say I've got a change of interest rate of 1/4%. This is going to change by 1/4%. And it's going to be magnified to the first power. Probably not a big deal. But what if it's a 30-year bond? You got that maturity hanging out there 30 years. You've got $1,000 hanging out there 30 years. $1,000 plus one coupon. Magnified to the 30th freaking power. That gets pretty big in a hurry. That gets pretty big in a hurry. So this is why we say that the longer the time to maturity, the greater the interest rate risk is, because those little changes in interest rates, they get magnified out there the further in time you go. Now I'm going to teach you a little Latin today. The word ceteris paribus. Ceteris paribus means all else equal. Ceteris paribus means all else equal. So when you guys are out at Buffalo Wild Wings on Friday night and you want to impress your friends, there you go. Ceteris paribus will be in class on Tuesday. Who knows? Right? All else equal. Okay. Ceteris paribus, bonds with longer times to maturity are more sensitive to these changes. We just talked about that. But let's talk about this next one. it's harder for people to comprehend. And that is that bonds with smaller coupons are more sensitive to the changes. Bonds with smaller coupons. Now, why is that the case? Remember, we said that the value of the bond is a combination of the present value of the coupons and the present value of the face value. Let's think about the bond with the absolute skinniest coupons imaginable. That would be the 0 coupon bond. How much of the value of the bond is dependent on that last $1,000 payment? Every bit of it, right? Every bit of it. And so that means that every bit of our bond value is is to the 30th power, right? And so just the tiniest little change can make a huge difference, and every bit of the value of that bond is hanging out there. However, what if we start to raise that coupon value? The present value of that set of coupons starts to creep up as a percentage of the value of the bond. And remember, those coupons are not all hanging out at 30 years. Only one of them is. Then we've got one at 29.5 years, which is slightly less sensitive, one at 29 years, which is slightly less sensitive, all the way down to 1 year and 0.5 years, right? And so we've got some of these coupons that are not sensitive at not very sensitive at all, because they're only out there for a short amount of time. And so it all boils down to what proportion of the bond is composed of coupons. The more value of the bond that is in the coupons, the less interest rate risk you have. So if I wanted to ask you to construct an extraordinarily risky bond from an interest rate risk perspective, what you would do is you would design one with a long time to maturity and 0 coupons. If you had a long time to maturity and 0 coupons, that would be the absolute most interest rate risk sensitive bond you could create. Questions? By the way, should those be things that you might just note on your note sheet? Yeah, I would think so, especially the second one, because it's not nearly as logically apparent. Now, let's take a look here. What we've got here are 2 bonds, and these bonds both have $1,000 face value. One of them has 30 years to maturity. One of them has 1 year to maturity. The yield, by the way, we tend to sell bonds, we tend to put coupons on bonds that we expect to allow them to sell at par. And so if I think the yield to maturity on the bond is going to be 8%, I'm going to put 8% coupons on it. Can you tell from looking at this picture what the coupon rate of this bond is? By the way, that should be yield to maturity on the bottom, not interest rate. Scratch out interest rate and write yield to maturity. Scratch out interest rate and write yield to maturity. What is the coupon rate for that bond? I mean, you could read the caption, but what's the other way we could tell? What did we say was true about a par bond? What's the relationship between the coupon rate and the yield to maturity? Yeah, they got to be the same, right? And so if we look where this thing is worth exactly 1,000, it's at 10% yield to maturity. Therefore, we know without even reading the caption that the coupon rate is 10%. Okay, I buy the 1-year bond, you buy the 30-year bond. And we both buy them on the same day, we both pay $1,000. And then the yield to maturity falls from 10% down to 5%. I'm so excited, my bond has gone up by 4.762%. So I call you up and I'm like, hey, my bond has picked up 4.762% in value. And you just start laughing. Why are you laughing?
Ours went up like $707.
Yeah, yours went up 76.862%. You're like, ha, sucker, right? I cry a little bit, even though I'm up, right? I still cry a bit. Now, time goes on. Interest rates go up. The yield to maturity goes up. It goes up to 20%. I am now down 8.3%. And I call you up and I'm like, oh man, I'm really bummed. My bond is down 8.3%. What do you say?
You're just down a lot more.
Yeah, you're down almost 50%. Do you see that? Okay. I was invited to speak to the top clients of this is a true story. I know you got that bullshit look on your face, right? But this is a true story. So I could, and it's at a trust company. What kinds of people put their money at trust companies? Rich people. And who do you think the top 24 clients would be?
Really rich people.
Yeah, the top 24 richest people who will show up for a chicken dinner, right? So that's what I'm there for. The chicken was pretty good. Okay, so I show up, and I asked this question. I said, how many of you have bought recently a 30-year Treasury bond? Almost everyone in the room, because old rich dudes, and they were all dudes. Old rich dudes like these bonds. Why are they buying Treasury bonds? What do they think is true of them? They think that they are
Risk-free.
Yeah, they think, and they're risk-free from a default perspective, but they're not risk-free from an interest rate perspective. And so here's I said, okay, here's what we know. We know that interest rates are mean reverting, which means that they go back to the historical average over time. I said, what do you think the historical average rate is for a 30-year bond? And they start tossing some numbers around, but they're in the ballpark. They're pretty sharp. I said, yeah, you're right. It's 7%. It was roughly in the 7% ballpark. I said, okay, the last 30-year Treasury bond that sold had 3.875% coupons. I said, anybody buy that one? A couple people did. I said, okay, let's look at what would happen to the value of your bond if interest rates merely return to their historical average. It was a loss in value of 43%. I thought they were going to have to call an ambulance. Because of course, keep in mind that old and rich tend to go together. I mean, not all old people are rich, but most rich people are old because they've been doing this thing here, right, for a long time. I thought they were going to have freaking heart attacks, right? And do you think they've ever invited me back to talk to them? Absolutely not. So, I'm at a chicken dinner. That's shame on me. Okay. Do you understand the relationship between interest rate risk and how even government bonds, which are default risk-free, still have this interest rate risk? And it's a big freaking deal, and it's so much worse when T is big. Questions? Okay, so here is interest rate risk in the real world. This bond was a 100-year bond. Its maturity was 2095. When does that mean it was issued? 1995, right? And the coupon rate when it was issued on December 31st, 1995 was 7%. And it sold for $1,000. What does that tell us about the yield to maturity on December 31st, 1995? What does it have to be? Yeah, it's got to be 7%, right? Because it's a par bond. Coupon rate's got to be equal to the yield to maturity. Okay, now, what was the price just, 7 months later? It's down to 800. What must have happened to yield and maturities in the meantime? Yeah, they've gone up. By the way, 100-year bond, is this normal? No, but it does make it extraordinarily sensitive to changes in interest rate risk. This thing lost 20% over 7 months. Now, I'm gonna give you a little insight into this bond. This bond was for General Motors. This is an actual bond. This bond was for General Motors. Now, why? There are two reasons why you might want to borrow money for 100 years. Can anyone think of one of them?
You don't have to pay it off anytime soon?
Okay, you don't have to pay it off anytime soon. Why? What do I think is going to happen to interest rates? What would one reason be? If I thought interest rates were going to go up, wouldn't I want to borrow money for the long term and lock that rate in? But there's a more sinister thing going on here. By the way, did they manage to do that? Yeah, they borrowed and then interest rates went up, right? So they're kind of looks like they're fortune tellers. The other thing, and this is, I think, what is true in this case, is that General Motors realized it was in trouble. And before the market realized they were in trouble, they were going to go out and lock in some loans at interest rates that did not properly reflect the risk. Okay, so there's the two reasons you might do that. Now, so we see a drop in 20% there, but if you go forward to September 26th of 2007, this thing is selling for $1,020.29. What do we call that kind of a bond? Premium bond. And what do we know about the yield to maturity at that point? It has to be less than how much? 7. It has to be less than 7 in order for this thing to be a premium bond. And so we see that huge swing once again. Now, this is your just for fun. What do you think happened to this bond? What do you think this bond's worth today? Just make a guess. How about 0? Why?
Don't ask me.
Oh, okay. Yeah, she looked certain. She's like, oh yeah. What's that?
Very high interest rate?
No.
Is it GM did they declare bankruptcy?
GM declared bankruptcy. GM declared bankruptcy. And this is the way it's supposed to work in bankruptcy. That the bondholders, by the way, we're going to talk about senior bondholders get paid first, and then all the way back to subordinated bondholders. And then at the end of the line, you've got the shareholders, right? If there's not enough money to pay off the bondholders, then they end up taking a loss. And that's what happened here. Now, here's the really fun thing. All these bankruptcies of the car companies happened during a Democratic administration. Democratic administrations in the past were considered to be allies of unions. The workers at the plants of the bankrupt companies were unionized. And they had actually accepted subordinated debt in exchange for some contract changes. Now, we talked about the order in which people should get paid off. The senior bondholders, people with this kind of debt, should have been paid before these subordinated debt holders. But because of who the subordinated debt holders were, we suspended the rule of law and we let the unions go to the front of the line. Now, remember the old guys that I told you about? The old guys, by the way, this has been a while back, but the old guys, a lot of them were like World War II vet age. And back in the 50s, what people would say is what's good for General Motors is good for America. And so they're the kind of people that were continuing to buy the stocks and bonds of General Motors long after the rest of us figured out that it was a bad deal, right? So they keep putting their money in. And some of them actually had bonds from General Motors. Some of them had bonds from Chrysler, whatever that was, Mopar. And then, so when the government ushered the subordinated debt holders in front of them, what did it mean for the amount of money they got out of the bankruptcy? Whoop! Do you think that pissed them off?
Yeah.
Oh, they were steamed, right? Would you be steamed? Absolutely. Now, going forward, when I see situations where companies with heavily unionized workforces are issuing bonds and those unions have subordinated debt, what am I going to demand? I'm going to demand a higher yield to maturity, right? Because I know there's additional risk. There's the risk that these people might get trotted in front of me at bankruptcy. Questions? By the way, is it fair to change the rules in the middle of the game?
No.
No, because people can't properly price risk. Now let's talk about reinvestment risk. Reinvestment risk is the risk that I'm going to have to reinvest the cash flows that I receive from this bond at a lower interest rate than I was originally getting. Now, you can either have reinvestment risk or you can have interest rate risk. You can't get rid of them both. And here's why. Because the very things that make interest rate risk high make reinvestment risk low. And the very things that make reinvestment risk high make interest rate risk low. Think about a long time to maturity. What are the chances that I'm going to have to reinvest this money if I've got a zero coupon bond with a 30-year maturity? I've got 30 years before I have to worry about reinvestment risk. Does that make sense? But what if I'm receiving coupons? Well, then at 6 months, I get this amount of money. And what do I need to do with it? I need to reinvest it, right? Now, if my coupons are small, maybe it's not that big of a deal. But the fatter those coupons get, the more I have to reinvest, the higher my reinvestment risk is. And so we said that interest rate risk was created by long time to maturities and skinny coupons. Reinvestment risk is created by short time to maturity and fat coupons. And so they are actually, they just, if you're getting rid of one, you're taking on the other. Questions? Here's the amazing thing. You now have enough to do homework 6. So we will not be extending the date on homework 6. I know you guys are thrilled to hear that. Okay, so let's get out our bond features slides. Go ahead and get your bond feature slide out. Slides. How many of you ever heard a conversation like this? Two guys, usually in their 50s, one of them says to the other one, "Nice Harley, man." And the second guy says, "Thanks, but it's actually owned by the bank." You ever hear conversations like that? No? Good for you. Okay, so because it's fallacious, meaning of or pertaining to a fallacy. I know what you guys have in your minds. Okay, so, like 3 people got that. Okay, so, why is this wrong? Does the bank truly own the man's motorcycle? No. What does he mean? Yeah, he's got a loan on the bike. And there's a good chance, because of the way depreciation works on new automobiles and new motorcycles, that that he actually probably owes more on it than it's worth. But does the bank truly own it? No. When will the bank take ownership of it? Yeah, if he stops making payments, then they send out the repo man. Does that make sense? Okay, now, we know that owners get to make the decisions. Remember, the shareholders get to make decisions at the corporations. The owners get to make decisions. And so, for instance, I owe money on my house. Does that mean the bank gets to tell me what to do with the house? No. As long as I live according to the contract that we have between us, I'm fine to paint the walls whatever color I want. By the way, gentlemen, ladies like to paint walls colored. Now, I know this is a terribly sexist statement to say that all women like that, but typically, women are more likely to want to paint walls than men, right? Or to want to get walls painted. Are they actually going to do the painting? No, you are. Okay, so, here's the deal, though. When she says, "I want to paint this wall green," what should you say? Yes. And here's why. She cares, you don't. I don't give a damn, right? I don't care. So let her paint the walls. Okay, so now there are some restrictions. For one thing, I can't have a puppy mill at my house. What's a puppy mill?
Like a puppy farm?
Yeah, a puppy farm. I've got 2 dogs. We are limited in my neighborhood, max 3 dogs, plus cats. So it's the sum of dogs and cats is 3 or less, right? So we got 2 dogs. We could take on 1 more animal there. Okay, so that's one of the limitations. Another one is that I can't have a meth lab in my house. What's that? Yeah. Oh, okay. So actually, the first time I was given this talk about a meth lab in my house, I had some students from China, and they're like, "Why would they be against having a math lab in your house?" I'm like, no, not math, meth. Okay. Now, let's talk about interest. Interest is considered a cost of doing business for the company. Interest is considered a cost of doing business, therefore it's tax deductible. This is different than we see with equity. Equity, you get those dividends. Those dividends are not tax deductible for the company. And so debt actually has what we call a tax shield. Debt actually has what we call a tax shield. We refer to it as the tax shield of debt. The unpaid debt is a liability of the firm. Now, liability in this sense means a legal obligation to pay. A liability is a legal obligation to pay. If we don't pay, then the lenders can take control of the assets. Just like we talked about the guy getting his motorcycle repossessed. What about dividends? Are dividends a legal obligation? No. Dividends are only become a liability if they are declared by the board of directors. Until that point, they are not a legal liability, not a legal obligation to pay. Now, we tend to break down short-term and long-term debt. And it's just like everything else in finance and accounting, 1 year or less is short-term. Anything beyond that is long-term. Now, notice that we say original issue maturity. There are two kinds of maturity we could talk about. I could say, well, that bond matures in 14 years. It's got a maturity of 14 years. That bond was probably issued to begin with 20 years or 30 years. The number of years that was when it was issued is the original issue maturity. And so a 30-year bond remains long-term debt even after it only has 6 months left. It doesn't switch over to being short-term debt. Now, we do talk about the current portion of long-term debt if you're really big into accounting, but it doesn't change how we refer to these things. Now, on long-term debt, we have basically two things. We have notes, and those are something greater than 1 year original issue maturity up to 10 years. And anything over 10 years we refer to as bonds. Now, I previously told you in this class that occasionally we use the same word in different ways in finance. And so you'll hear people talk about bonds, meaning this entire universe of notes and bonds. And then when we get within that context, we'll say, well, really bonds are just greater than 10 years original issue maturity. So don't let that freak you out. People do that. So if you're ever unsure about what they're talking about, so ask, what is the original issue maturity? By the way, most people are going to say a 20-year GM bond or a 20-year General Electric bond. They'll throw it out there. Okay. Let's talk about the bond indenture. The bond indenture. An indenture is a contract. In the beginning, the United States, by the way, we're a nation of immigrants. The way a lot of people got here was something called indentured servitude. Indentured servitude is where a poor person in Europe would sign a contract with a business person in the U.S., usually a craftsman of some variety, and this contract was called an indenture. And they would say, I agree to work for Mr. Tips for 5 years. Mr. Tips will provide my transportation to the New World, my food, my clothing, and my training in whatever. What is it that you do, Mr. Tips?
IT auditing.
IT auditing. So he's going to take on this indentured servant from the old world, and he's going to mentor them in IT auditing. And after 5 years of basically giving you free labor in exchange for their passage, food and clothing, and this education you're giving them in IT auditing, now they are free to move on. So that is how probably some of my ancestors actually got here, because I don't come from rich folks. Okay, back to the story. The indenture, therefore, think about that as a contract. It's an agreement between the borrower and the lender. And it contains information about the bond issue. And I'm going to go through each one of these things in detail. But first, let's talk about who writes the contract. Who writes the indenture? When you go to borrow money from the bank to buy a car, who writes the contract? You or the bank? Yeah, it's the bank. So the lender, in the kind of contracts you're used to, the lender is the one that writes the contract. Here's what's going to truly freak you out. In bonds, it's the borrower that writes the contract. In bonds, it's the borrower that writes the contract. And here's the reason why. With you and the bank, it's one borrower and one lender. But with bonds, it's one borrow and thousands of lenders. Do you think even if just the universe of bond investors was just this room full of people, that I could get you all to agree on the appropriate contract for this bond? Probably not. And so what I'm going to do as a borrower is I'm going to put together an indenture, a contract, that will be, I think, attractive enough to get enough people to buy my bonds that I get enough money to build a factory or buy a building or whatever it is that I'm trying to do. Okay, so it's the borrower or the bond issuer that writes the bond indenture. So we're going to talk about each one of these things. First of all, there are the terms of the bond issued. And one of those terms is the face value of the bond. Now, I told you guys that by default you expect it to be 1,000, but do you think the lawyers are going to let us get by with that? No, man, we got to state that in the bond indenture. And also the coupon rate will be included there, the maturity date, when is that last payment going to be made, and then something new and fun, the bond form. So there are two ways you can hold bonds. One would be in the registered form, and that is where basically the bond just exists electronically. The borrower knows who I am. They know my address, they know my social security number, and they know my birthday. And by the way, they probably also know my checking account because they're going to direct deposit my coupons into my checking account every 6 months. That's a registered holder of a registered bond. The other kind of bond, which is how bonds started out, is the bearer bond. What do you think a bearer bond is?
Did you guys have a paper?
Yeah, it's paper, and who can sell it?
Anybody?
Yeah. Have you guys ever watched Die Hard?
Yes.
Great Christmas movie. Okay, Die Hard. What are they trying to steal from the Nakatomi building? Bearer bonds. Why bearer bonds? Because anybody can sell them, right? Now, you say, wow, that sounds pretty cool. What kinds of things do you suppose bearer bonds might be really good for? By the way, if they know my name, my birthday, my address, and my social security number, what do you think is going to happen every time they put money in my checking account? Who are they going to tell? The government. And what does the government expect out of me? Taxes. And if I don't report, if I don't include that on my 1040, what happens? Yeah, they're going to smack me down, right? Okay, so if I want to cheat on my taxes, which I'm not telling you should, but if I want to cheat on my taxes, I prefer bearer bonds. Why? Because I take each one of those coupons, I slide it across, and they slide me some money, right? And it's just up to my honesty as to whether I report that as taxable income. Because after all, nobody has a record of who owns that bond. Now that was true up till September 11th, 2011. No, 2001. September 11th, 2001. What happened then?
World Trade Center.
Yeah, terrorism, World Trade Center. I remember that day. I was sitting in my little cubicle, and the ladies in the procurement department next to me were listening to the radio. And they're like, yeah, an airplane's hit the World Trade Center. And I'm like, an airplane hit the Empire State Building in World War II. It happens, right? When did we know something was terribly wrong? When the second one hit. Okay, so after that, the government says, whoa, we can't have this bearer bond crap going on without knowing where the money's going. So now, when you go to turn in that coupon, by the way, why do they want to clamp down on that kind of behavior?
Criminals?
Yeah, in this case, terrorists, right? By the way, do you think terrorism is cheap? No. You gotta have some money. And you gotta have ways to get the money in. And bearer bonds was a good way to do it, right? And so they're like, okay, going forward, whenever you turn in a coupon for a bearer bond, you have to present your driver's license, you have to give us your address, your birthday, your social security number. What do you think happens now?
Gets reported to the
It gets reported to the government. And not only are they looking for the taxing, they're also looking for the terrorism thing. Does that make sense? Okay, now, let's talk about bearer bonds and some of the other dangers of having bearer bonds. Let's assume that you've got bearer bonds and you have them hidden under your mattress. And after a rough night of clubbing, you go home and you're relaxing in your bed with a Benson and Hedges. Do they even make those anymore? No. Let's call it a Marlboro Light. That's more your speed, right? Marlboro Light, and you pass out and go to sleep. And you wake up just in time to avoid the flames of your mattress. And you're like, whew, dodged a bullet. And then you remember, oh, damn, my bearer bonds were between the mattress and the box springs. And so you go back in there and you're like beating on the mattress with a pillow and you're trying, but no, they're gone, right? The next day you pick up the phone and you call, let's say they were General Electric bonds. You call General Electric and they're like, can we help you? I'm like, oh yeah, last night my house burnt down. They're like, dude, that was rough. And you say, well, the big problem was that my GE bearer bonds were between the mattress and the box springs, and they're gone now. Do you think they say, oh, don't worry, we'll send some more out to you right away? No. If they would, I'd be making that call every day. Guess what? It happened again, right? So, you've got fire, you've got theft, like at the Nakatomi building. These are the risks of holding on to bearer bonds. Does that make sense? Okay. By the way, 95+% of all bonds today are registered. And here, this is so much fun. People are interested in after-tax return. By the way, when you get a paycheck, are you interested in the big number or the little number? Yeah, it's the little number. The only time we mention this big number is at like class reunions and shit, right? When you're bragging to your friends. But what you're really interested in is this number down here. Now, it's true of every human being. We're interested in the after-tax return. So if an item would allow me to cheat on my taxes, what does that mean about the required before-tax return? I'm not going to require as much. Does that make sense? And lo and behold, there are these bonds that are being sold over in Europe that are denominated in US dollars. They're issued by US companies, and they are bearer bonds. And the yield to maturity on them is lower because those people are cheating on their taxes. Now, who buys these bonds? Rich Europeans who are sitting on a stash of dollars. Does that make sense? Now here's the other fun thing about these bearer bonds. Most bearer bonds are semi-annual coupon bonds, but for these dollar bonds over in Europe, they only pay once per year. And why is that? Because when you take your family for your annual skiing vacation in Switzerland, what can you do?
Get your coupon.
Yeah, swing through Zurich. You walk in there wearing your oversized ski jacket, but you know, it's kind of loose on you, and you walk out and you've got the pocket stuffed with money because you just cashed in your bearer bond coupons. Now, how much of that do you think they report to the taxing authority?
None.
0. Is that sick?
Smart.
People are scumbags, right? Any questions? Yes?
Could you like transfer a registered bond to get bearer bonds? Like if you got like a grandfather in there wanting to give inheritance? Could
No.
you-
Sell the bond, take the cash. Yeah. Good question. Other questions? Okay, I will see you next time. Be prepared to talk about chapter 6 next time.